Well, good morning and welcome back to the FEG Tax Package. I'm Joe Clark, happy to have you along. Hey, we are talking about your financial journey, and as fiduciaries, the four things you have to pay attention to: the risk and volatility that happens inside of the marketplace, the fees and expenses that you're exposed to, the tax planning that needs to occur annually. And remember, you are on a journey. It's not just this one hit wonder, it's all the years. And last but not least, really is the real return, or the inflation rate. Now, we've focused our tax planning package on helping you better understand your tax return, better understand what it is that FEG is already doing for you, or if you're not working with FEG, things that you may want to consider. And I mean that seriously. This is not a matter of where I'm trying to hold back and tease you and say, hey, you have to call us. If you want to do this on your own, that's your business. I will strongly encourage you, because of the nuances of the tax code, the things that can get missed. I believe it is worth paying for a professional. So whether it's Financial Enhancement Group or somebody else that is trained in tax planning, and I do mean that. Don't just listen to somebody says that they're a broker or they have a securities license or they're your friend from church. That is not enough. And you can refer back to my article on competency versus character trust. You need to have somebody who's got a demonstrated experience in this that really knows how to do it and engage in it, in my opinion. But in the meantime, we went through and we talked to you about how to look at your return, how to think about your return, how to understand changes that were taking place. And now the strategies really get into where we're going to do things that are proactive. So there's triggers and transitions that occur in our lives, some that are predictable based on age, some that are just, oh my gosh, how did that happen? You know, the loss of a spouse or the loss of a job, turning 72 and a half, or 72 rather, that's pretty predictable, right? But there are other things where you can influence your return. So last week we talked about bracket bumping. Again, if you missed that video, don't forget to call 833-TAX-PACK or go to fegtaxpack.com, get signed up. We'll start you on the series of getting you the videos so you can get caught up. Each one of these is a building block, if you will, or a series of things you need to use. So we talked about bracket bumping. That is maximizing your exposure to the lowest tax bracket you will likely ever be in. Every time I talk about taxes, I will talk about a series of stair steps. I taught financial planning to Purdue seniors for 7 years, 14 semesters, as I like to say. It sounds longer, felt longer. I loved it, actually. Five of our graduates work for us at the Financial Enhancement Group, and there's nothing like being able to pick the cream of the crop, right? So it was a beautiful deal for me and hopefully for them. But this is the way I teach people taxes, is to think about a series of stair steps. So as your income increases, part of your money is taxed here, then part of your money is taxed here, then here. So whether you're Warren Buffett, Bill Gates, or yourself or me, we all have some money that's taxed at 10%. Our filing status dictates how much this step can hold. If you're married filing jointly, you get more money at 10%. If you're filing singly, you get less. Bracket bumping, the concept was to maximize the bracket that we're in. What marginal rate are we married to? Now, one of the things my team will help you with is best predict, especially with the loss of a spouse, what bracket you're likely married to into the future. Many people married are at this bracket, and when a spouse passes away, absolutely opposite of what you hear, many people are forced into this higher bracket. That wasn't true 30 years ago. Probably wasn't even true 20 years ago. But we've watched people pass away and their spouse end up paying as much as 53% more in tax to the IRS the following year, simply because their husband died. And that's what happens with IRAs and 401ks, or what we call defined contribution plans, as opposed to pension plans that used to be the predominant source of retirement income in the past. It is a different world. So this session, we're going to talk about double stacking. So if you remember, when you're reading your return, and I think that was in assignment number 2 or 3 of these videos, when you were reading your return, you went through and you looked at line 11, which told you your adjusted gross income, or AGI. That was all of your income from wages that you earned, interest, dividends, capital gains, sales of property, Social Security, whatever the inflow was. is added together to come up with your AGI. And then on most returns, you have some deductions, in some cases, even tax credits. The deductions are either a block of money that the IRS gives you and says, we recognize it costs a little bit to be able to exist in the United States. That's called your standard deduction. And that standard deduction is about $27,000 if you're over age 65. It's like $27,400. Don't get caught up into the numbers. I want this to be as worthwhile for people as we can. That's a standard deduction. Or you can itemize. So if you're itemizing, your total itemized deductions need to be greater than $27,000 or it was pointless. Now, key concept here in the double stack is understanding you get that standard deduction each and every year, but it doesn't go with you if you didn't use it. So what can you itemize? Well, the big three, as we talked about in reading your return, are state taxes, state and property, but remember, it's capped at $10,000. Mortgage interest, but the big one is charitable gifting. It's philanthropy. It's the money that you give to your church, to Purdue, IU, AU, Ball State, wherever. It's the not-for-profit organizations, Habitat for Humanity, the Christian Center, whomever, right? It's this charitable gifting. And what we find so often in our office is the people who come in are making charitable gifts, but they tend to have their homes paid for. You don't have to. Hey, full disclosure, I don't have mine paid for. It's at 2.5%. They can pay it off when I die, but at 2.5%, I will continue to make mortgage payments. They are not getting a dime extra unless somebody calls and says, Joe, you have to pay for some odd reason, right? So mortgage interest, the standard deduction, again, or the state tax, which again is capped at $10,000, and then you've got that charitable deduction that's there. And so the example that I gave, I believe when I was talking about how to read your return, was that this number was $30,000 on a return, right? The 27 was free. I think it was $29,000 was actually what happened. The 27 is free. The CPA said, hey, you get an itemized deduction of 29 because when they added all of the numbers together, all of these three things together, they had $29,000 of deductions. 22,000 of it was charitable deductions, by the way. 22,000 was charitable. So the CPA said you get a $29,000 itemized deduction. I say, whoa. No, you don't. Because the 27,000 is free and clear. Now, let's think about this. Let's say you're at the 12% tax bracket. That means every dollar that you earn really costs you $1.12. We'll leave off the state tax right now, right? Every extra dollar you earn costs you $1.12, right? So every deduction that you can take is worth 12%, right? Every deduction you can take is worth 12%. So anything they gave more to charity than that $27,000 standard deduction, they essentially get a 12% break for. It only cost them 88 cents on the dollar to make the gift. The challenge, ladies and gentlemen, the challenge is the $27,000 is lost. The $27,000 freebie that should have saved 12% on the $27,000, right? Or, let's just call it $2,500. It's $3,000 that you could fold over and put in your billfold is lost because of the taking the standard or the itemized deduction because of the charitable gifts. So here's what we do in the double stack. We look at your resources. If you don't have resources, you can't do this. We look to see where you are, where your charitable taxations are, and we help you accelerate in 1 year the amount of money that you pay in state taxes and the amount of money that you give to your charities. So you go through this year, let's just use the charitable example. You go through this year, you give your church and your university all the money that you would normally give them, but in December, you give them the money that you plan to give them for the following year, the following calendar year. Now, from a tax perspective, we have itemized deductions for 2 years, all inside of 1 year. So it's not a $29,000 standard deduction or itemized deduction. It's 29 plus we're going to give away another 22. So suddenly we now have $51,000 of itemized deduction. Now that 12% savings on the $51,000 is a beautiful thing. We can choose to use it to do Roth conversions. We can choose to just enjoy the fact that we're paying less in taxes. However you want to think about it. Your charity's got the same amount of money. You were able to use resources ahead of time that got a 12% guaranteed return if you're in the 12% bracket. I don't get to say guaranteed often. It's a guaranteed 12% reduction because you're double stacking your itemized deductions. And then next year, you're going to turn around and use the standard deduction. You're going to be like 90% of America who takes the standard deduction and doesn't file an itemized return. That, my friends, is the double stack. More often than not, it is able to pay for our fees, certainly pays to have your tax return done. Again, we are not CPAs. Don't pretend to be one on radio or TV. We have CPA partners. The Huth Thompson people are in Lafayette. B-Step Doctor is here in Muncie and Anderson. More than happy to sit down with you, share ideas and concepts with you over the double stack. I want to say this one more time. If you want to do this on your own, God bless, it is your business. That's fine. But if you're looking for a fiduciary, that is our business. And we would strongly encourage you to call 833-TAX-PAC or go to fegtaxpac.com. Get signed up. We'll send you the previous videos. It is a building block. Whether you're working with FEG or not, I would still encourage you to try to get a separate set of eyes, professionals, people who are trained in tax planning, not just selling annuities or calling themselves a stockbroker or being in the financial services. Find somebody who has demonstrated understanding of how the tax code works to make sure you're not missing any of the nuances to get involved in this tax planning. In 35 years of being in the financial services industry, I started 2 weeks before the crash in 1987. I have never seen anything more interrupt what I would call an adequately prepared retirement plan. In other words, you saved the right percentage of money, you were diligent with your 401k allocation, and you retired, and you thought it was going to be this way, but it wasn't. And that number one distortion, interruption, and sometimes truly even devastation comes because people didn't understand the tax code. I congratulate you for taking the time to learn and to understand this stuff. If there's anything we can do to help you, just go to yourlifeafterwork.com. Call us at 800-928-4001. In the meantime, fegtaxpac.com. Get signed up. Get the previous videos. More than happy to work with you and sit down and share some ideas. Have a great week. We'll see you again next time.